along, of course, with Mike Santoli, who remains. Peter, globally speaking, as you do, what can you tell us at this point in terms of the impact that we've seen from this unwind of the yen carry trade, how far it has to go, and what you think about the impacts it's had on markets over here?
Well, I think that the setup of this correction is important for context. Bear in mind it came after one of the strongest first halves, at least for the US equity market, that we've seen over many decades. And really since the trough of the markets that we saw last October, global equities had already risen by about a third and the Nasdaq by about a half. So we'd seen this tremendous rise. Now, a lot of complacency really built into the markets, really as a function of optimism about AI. So I think in a sense this correction was healthy and somewhat inevitable after such a long period without a pullback, particularly as you started to get some signs that the US economy was slowing. We'd already seen good evidence that that was happening in Europe and China. My feeling is that this correction, although is stabilizing, is not yet over. We're still going to see, I think, some choppy environments in the short term as investors really start to calibrate and get more confident again about the direction of interest rates in the economy. But at the same time, I think we're not in a bear market and there are going to be some good opportunities.
All right, so a little bit of everything here. Mike mentioned earlier the multiple on the Nasdaq, for example, has come down. It's around 24 times. Is that enough to encourage some who might otherwise not have taken a chance to say, okay, fundamentally, at least, this seems like a decent entry point?
Well, I think it's probably not come down enough. I mean, the US equity market broadly has moderated in valuation a little bit, but it's still right at the top of its long-term range. And that's true whether you exclude the largest tech stocks as well. Now, admittedly, lower interest rates, if they come through, and the markets are expecting that now, will help to stabilize the markets and valuations. But I think we could see a bigger shakeout in valuations yet before you really start to get, value investors seeking it out as a good correction opportunity.
Mike, we've seen in the last 24 hours quite a bit of Fed soothsaying. You have a market that has rapidly moved to price in much more in terms of rate cuts before the end of this year. And even Steve Wiesman this morning sharing from his own reporting that perhaps 50 basis points is now on the table in September. It wouldn't necessarily take a recession or even a growth scare to get there. It's just the fact that Fed's forecasts are now playing catch up to what we're seeing in the data. So how much does that matter here?
That's right. I do think solidifying around perhaps a September cut, not an emergency cut before that, and 50 basis points does make sense because the market recognizes usually that once an easing campaign begins, it's the beginning of a series. And if you look at the gap between the Fed funds rate now at 5 3/8 and where the 2-year yield is trading, it's massive. And so that's the market's way of saying Fed's a little bit late, has more to do. I think that's fine. I don't know that we can go to the historical playbooks and say, hey, here's how the market behaves in the first rate cut, because it really hasn't conformed to those patterns up to this point in terms of how we traded into the first Fed rate hike during the tightening campaign, bottoming when we were still tightening. But I do think it would take the pressure off if the consensus kind of coalesces around that idea. By the way, rate-sensitive parts of this market already responding, right? You're seeing utilities and you see home builders and REITs and things like that actually outperform.